Today, we're gonna talk about how to determine if it's a hot market or a cold market. That's where you really make your money. What you wanna look at is I wanna give you a clear picture of what you're gonna be looking at. It's called equilibrium. Equilibrium is a balance. That means that you're balanced, your inventory is balanced. So on one side, you got a need for new inventory. On the other side, you have hypersupply, which means you're overbuilt. This is right here is when you don't want to sell over here. It's when you want to buy. You want to buy on the way down. Right here, right when you start to break through equilibrium, that's where prices are approaching new construction level. Why? Because we didn't have enough demand, so we had to continue to push. Now this number can drop suddenly. Jobs come out of the market, boom, go down. It can also, you can go into hypersupply and then you have a bunch of new jobs come in, you're out of hypersupply. So how do you know what jobs are coming into the market? How do you know how to value jobs? And when I say value jobs, some jobs are more important to the economy than others. So let's say, and I'm not talking about demeaning anybody, but let's say you're a banker, right? And let's say you're a teller and you work at the bank. Right? That's a service job. That doesn't really create jobs. That just services jobs. What that does, it takes money, it circulates it in the economy. Let's say that you are a auto manufacturer, right? And let's say that you started, we got one here in Cincinnati, it's called Workhorse, and it's an electric vehicle manufacturer out of Loveland, Ohio. And let's say that you're them, right? What are they doing? They are creating jobs and they're creating money from all over the country because they went public. And so now Wall Street, they went and sold off all these stocks and sent all that money over there. Hey, here. So now all this money is building up in this community and they're hiring all these people and you have a funnel of money coming out of the clouds into your community. What do you think is gonna happen? That area is going to go up in value. There's gonna be more need for housing. Those are called basic jobs. And that's durable goods manufacturing. So them have about an 8 to 10 ratio. For every one job you create, they create 8 to 10 more jobs directly and indirectly in the community. So if you can find an area, it's already got a tight market, and then you have a new driver, a new job coming in, boom, you're gonna break through that. That is a hot market because the appreciation is where you make most of your money in real estate. On the other hand, let's say you find an area where you have all these jobs about to move out. What do you think is going to happen? The rents are going to drop, you're going to have an oversupply, and you're going to have a similar situation like what happened in Flint, Michigan from 2000 to 2020. The prices now in 2021 are lower than they were in 2000 in Flint, Michigan in a lot of areas. And the rents haven't moved up much. So if you got a property and you held it for the past 20 years, you were hoping to retire on it, it's worth less than what you bought it for. The cash flow is not there. And now the property needs $20,000, $30,000 infused into it. Where are you going to get that from? That's a cold market. And there's only a few cold markets in the country right now. I would say Flint is one of them and Memphis is one of them. I just got a 300 unit building over there for 2.1 million. I was like, I'm good. Cause it's too much work. It's too much oversaturation. The rents are too low. There's no big drivers coming in that are gonna push that up and need more housing. So what's gonna happen? The housing is gonna sit there until they start tearing it down. You're not gonna need more. So you wanna stay away and avoid those areas because yes, they may have great cash flow, but keep in mind, cash flow is not gonna help you pay for all the repairs they're gonna be needing 10 years on that property. So that to me is a hot market, one where you have already tight occupancy, where you have a new driver coming in, and then you're able to buy well below rebuild cost. In other words, I can buy for 100 a square foot, rebuild cost is $250 a square foot. I can rent this thing out for the 1% rule, which basically means I'm in it for 150,000. I can rent it out for 1% of that a month, which is 1,500. Probably gonna be a good buy and hold long term because that property is likely to go, let's say it's 1,500 square foot, paid 100 a square foot for it. That property to build new now is probably 350, 325. So what's gonna happen is you have more demand coming to the market, that property is gonna go up in value. So if you wanna know more about how to identify those type of areas and how to buy in real estate, and you need a clear path on how to become a millionaire in real estate, how I did it, click on the link below. I got a course out and you can go on here and learn all this stuff in 10 to 12 weeks. We'll see you guys in the next video. Make sure you subscribe and hit the like button and click on the bell. Thank you guys.